Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, a network for family offices based in Greenwich, Connecticut. Please subscribe to circulus.substack.com to stay in the loop. The podcast spent a delightful afternoon with François de Visscher, a fourth-generation family member of the Belgian multinational firm Bekaert, which was founded in 1880. François has been a long-time respected consultant and banker to family offices and family businesses, and it was a real pleasure to listen to his accumulated wisdom. We spoke about his own family experience and their family office, what family offices get right and wrong about direct investing, where families have an edge over private equity funds, and how to compete for top talent against the street. Most interesting of all were the rules the family created for joining the family business. By requiring education and experience outside the business, family members often found their own successful careers. François de Visscher is a Belgian-born advisor with more than 30 years of experience advising business-owning families. In 1990, he founded de Visscher & Co., a leading independent advisory firm for family and closely held companies that has advised more than 300 family enterprises worldwide. He previously founded Wall Street's first family business group at Smith Barney, and most recently co-founded FODIS LP and Family Capital Partners, and serves as a senior advisor and associate partner at Cambridge Advisors to Family Enterprise. François is a shareholder and former director of his own family's global enterprise, NV Bekaert SA, headquarters in Belgium, and founded by his great-grandfather. Today, the Bekaert Group generates approximately $5 billion in annual sales, operates in more than 120 countries, and is publicly traded while remaining controlled by the Bekaert family across 5 generations. Mr. de Visscher has served on the company's board of directors and is a member of the Family Council. François is honorary consul of Belgium in the United States. He holds a Bachelor of Economics with honors from the Université Catholique de Louvain and an MBA from Rutgers University. Please enjoy my conversation with François de Visscher.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
So, why don't you tell us where you're from and where did you study?
I was raised in Belgium, a town called Louvain, which is outside of Brussels. University of Louvain, the oldest university, the second oldest university in the world. And I grew up, did my undergraduate studies there. I studied economics and applied economics. And then I really didn't know what I wanted to do after. I know I wanted to get into business, but I wasn't sure about what area, what and all this. Probably more finance. So the CFO of our family company was my uncle. I talked to him about what should I do, and basically counseled me, look, in order to get into finance, the first thing you need to learn is accounting. That's the language of finance, and a lot of financiers don't understand accounting in there. So then I decided to take a job at Coopers & Lybrand in Brussels, and then they sent me actually to the States to get an MBA, which I did at Rutgers, while I was working with them in their office in New York as an accountant. So after I got my MBA, I got my CPA done and worked for them for another 2 years, learning accounting, and then moved into investment banking at Smith Barney, and the old Smith Barney. And initially the international corporate finance, M&A, and then became a partner at Smith Barney in 1986, and started then the family business group at Smith Barney, which is kind of the first one on Wall Street really focusing on family businesses. The conventional wisdom of at that time was that family businesses were small businesses with mom and pops and all this, and not realizing there's a whole world there of family offices and family businesses that are substantial businesses. But Wall Street was so focused on the public markets and really not focusing on the private market as much. I grew up in a family business myself, so I knew and particularly in Europe, I knew what the world of family businesses was, and so many family businesses already had family offices in Europe way before they became popular in the United States, obviously.
Could you tell us about that? Tell us about, you grew up in a family business. Your
Right.
Your great-grandfather started.
So my great-grandfather started a family business in 1860, making barbed wire. So he was a young 12-year-old, took over the family hardware store when his parents passed away. And basically, one of his customers came to the front of the store and showed him a piece of barbed wire and asked him where he could make that. And he did the usual white lie of an entrepreneur and said, sure, we can do that. No problem at all. And worked all night really on his first roll of barbed wire, using a wheelbarrow to basically roll his first wire. So the business from there grew from basically making fencing wires to all different ferrous wire products, springs and cables, and we had at some point we were making springs for mattresses, we were making springs for automotive. We made all different fencing type of products. And then came and that was the first generation. Second generation of family, they got more and more international. At the second generation, just around the turn, basically the end of the World War II, we got approached by the Michelin company to buy basically their patents to do tire cord, which is the wire that goes into radial tires, which we developed successfully, technically successfully, and now have a very significant market share of tire cord in the world now, with 40 different plants around the world doing tire cord for various automotive. U.S. initially and Europe, now more and more in Asia, obviously. But that was a big impetus, if you want, of the family business into the second generation. The second generation had one very important leader, which was my uncle, who's a very powerful person, not just for the business, but also the countrywide. And in typical fashion, family business, there was not a lot of preparation for succession. So when he passed away, there was tremendous infighting in the family as to who was going to be the leader.
When was this?
That was basically in the 1960s. And one of his philosophy of this granduncle of mine was that he was very, very much of a family man and very much wanted to have all family members involved in the business while he was there. The board of directors was your typical board of directors of family business, which is basically a lot of people are on the table, but only one person making decisions, and that was him. But he had all his sons, nieces, and nephews, obviously only males at that time, were all involved in the business in some fashion, including one of my uncles who was an architect. He was sitting on the board because he was going to build the plans for the... You can imagine, Joe, that's when he disappears, it's like infighting to begin with.
Now, is this typical in European family businesses?
At that time, very much. Oh, yeah, very much. But even today, if you look at, I know you're looking at their succession thing. The family business in Europe actually have perfected the succession model better than we have in the U.S. And maybe it's because of history, and that's why you see a lot of the family business in Europe, not just because of their age of the business, but also they've been very successful in passing on to next generation. Not all of them, obviously, but...
What do you think they're doing differently?
They're more clear about the succession model that they want to establish in terms of the structure. I think it's more of a meritocracy more than in the U.S. versus more based on rank of family, based on things. So the succession model is a lot easier in European fashion, like typically, take your example of our family business, typically the eldest son basically was the one who was going to run the business. And he passed away, so his brother took over, and he was the powerful leader that I was talking about. So the founder of our business had 5 children. There were 2 sons and 3 daughters. And when he was thinking about his succession, he had started working with his oldest son first, and then when he passed away, the first son passed away early in age. It was the second son who became but it was a very established model, Joe. And that's exactly what didn't happen at the third generation. We had everybody involved in the business, or in some fashion in the business, but no, clearly there were several people in the family, uncles and all this, that had more important roles in the business. So all 5 broke loose, and we basically then lost about a quarter of the family that basically decided they didn't want to get involved in it anymore. They wanted to get bought out, and that's how the business became public, because we didn't have the capital to buy them out, and we went public. Today, the family is still very much control of the business, but we're a public company, which is a whole different, I think in retrospect, today, if we had other ways of financing the buyout of the branch of the family, we probably would never gone public. We would use private capital, because the public market are not really market that are very friendly for family businesses. They're, first of all, they're obviously very short-term quarter-to-quarter earnings oriented, and which is not the way you run a family business. I think making long-term investment is. But also, I think because the notion of the regulatory environment for public companies is very much for the protection of minority shareholders, make sure that there is information, make sure that everybody is informed and protected, because that's how the regulator is thinking about it. They're not necessarily thinking about the people that actually have been investing their capital, their sweat equity for generations into a business. So that's one of the reasons why I'm a firm believer of private capital for family companies, and why I got into how you develop partnership between family offices and family companies.
Now, were you expected to join the business when you were growing up?
So that's an interesting question. When all the infighting started at the third generation and son of family sold and all this, the third generation got together, the rest of the family that was still involved, the other 4/5 of the family that were still involved in the business, got together and said, okay, we can't have this repeated for the next generation. So let's make rules for who's going to be for who from the next generation is going to be involved in the business, and what are the rules of entry. And the rules were sent to us basically saying, okay, if you guys want to enter the business, here's the rules. And they had actually a committee, a next generation committee, that they actually set up those rules. And my father was actually running it, which is interesting. And one of the rules had you had to have an MBA or an equivalent graduate degree to get in. You had to know at least 4 languages. You had to have at least 5 years of experience outside the business in another business experience. And then there were some other minor things, but those are the key. And the philosophy, Joe, was also that if you enter the family business, as a family member, you want to make sure that you can prove to anybody who's not a family member in the business, any other management team member that you have, that you're not there because of your family, but there because of your marriage, because of who you are, which makes a lot of sense. And we also want to make sure that we attract, obviously, the best elements of the family to enter into the family business, and they have the right experience and all this. So all the intentions were great. Except what happened is that, so we all told about those rules. We said, okay, great. Same for me. So I said, okay, I'll go into investment banking and do my work and all this. And when my uncle came to me after 5 or 6 years of experience saying, okay, now you're ready to enter the family business, you want to think? I said, but we don't want to do that. I didn't want to join it. I said, very happy in investment banking, happy in New York, and all this. It's like, and a lot of my cousins were similar. They had developed their career. One of them was a senior, was at Bain Consulting, became Bain Partners. And so they all came to the kind of all the elements that had, I think, well, we don't want to, why do we want to? We're very happy, and it backfired to a certain extent, because the cousins that were struggling through the 5 years of experience and all this, and knocked on the door and said, please, can I go in? And not necessarily the element that you want to get into the business. So as a result, quite frankly, at our generation, there were, except for 2 of my cousins, there were only 2 that actually entered the family business at our generation. And that's when we started to develop a real model for, and we had a chairman that is an outside chairman that was fantastic, that really helped us develop a real government system for the business with outside management, and the relationship at the board between the family member, the outside directors, and the outside management, and really the symbiosis, which really worked beautifully, very successful for us. At the same time, we then pushed also, because the family was not directly involved in the management of the business, to develop our family governance. And really because the family was growing, and we want to make sure that we keep that healthy relationship between the family and the business, if you want. So we started developing our family council, we started to develop our family office, and that was really the origin of that. Had more of them been involved in the family business, maybe we didn't see the need at that time to develop that family governance, maybe, I don't know. But the result for us was actually that it was a healthy outcome, that today the business is totally professionally run, and probably will continue to be like that. Maybe we'll have at some point at the 5th generation, maybe we'll have some, I don't know. But at least at this stage, it's a very healthy and very professional management. And quite frankly, I think for a family business, Joe, I think it's actually a good, and it's a big question also about, shall you be CEO, shall you be chairman, shall you be family member, not family member, and all this. I'm becoming more and more a proponent that the family's role, I think, has to play at the board level And everybody knows at the board who the owners are. Okay, so there's no question about the other day what they think. But I mean that you have a much greater accountability if you have outside family, outside management running the day-to-day business. So if you look at the family and the board setting up the strategy and the direction of the company, and then the execution to outside management, I think it's a much healthier, I think, for once, it's because you can make them much more accountable than if you have a family member that's running as a CEO and he's part of one branch. So you want to make sure that you have all the family dynamics that get into the evaluation of your management team, which shouldn't be there.
So you were on the board for 25 years.
25 years.
How did you see that dynamic evolve? Were there issues between the different branches? Were there ways to create harmony?
So one of the issues was obviously as the family grew was the selection of directors at the board. So how we're going to select directors, the family directors. And so we went back and forth between branch selections and branch representation and just meritocracy on the basis based on so initially it was all branch. So initially it was basically, we had 8 board members from the family, 2 per branch, and then we had 4 outside directors. When we started to be more active as a family office, and we started to look more at
I'm sorry, was that separate? The family office?
Yeah, so when we set up so our structure basically is that we call the family office, it's really the family council and the family office, because the board of the family office is actually the family council, and it's a holding company. So we have a family holding company that owns the shares that are owned by the family. Now there's some individual shares that are owned separate by family members. We all own shares outside of that. But the bulk of the shares that are owned by the family are owned through a holding company. And the holding company has a board, and the board is actually the family council. So the board of the holding company, which is for us synonymous to family office, is basically all family members. And that's where we have the branch representation, if you want, at that family office level. Below, when you go to the operating company, we have 8 family board members, but they're not all necessarily representing branches. They're actually representing the family office. So they're nominated by the family office. And in fact, our way of nominating, which is very interesting, like for instance, when my seat came up, my nephew took over my seat on the board, who, by the way, is doing an amazing job, and he's a super qualified managing director of Bain Capital. He's got really, really serious background and serious resume. We went through a process of selection where, through the family office, where we had the chairman of the board, the head of the family office, and 2 outsiders, not directors of our family company, but 2 outsiders from another family to evaluate the candidates of the family that would be taking over my spot as director. So it's a very interesting process. So it would be like we would taking Paul Carbone or Pritzker or somebody to evaluate our family candidates to become member of our board. I think so. It was really as impartial as you could find. For my seat, we had 4 different candidates that came up out of the family to take over my seat, and this one was selected, but it was based on this process of a committee, if you want, that was set up with the outside. So I think that the evolution on the governance, I think for us, has been really much more focused on activities of the family, through the family council, through the family office and the holding company, and then basically delegating essentially from that family office who's going to be sitting on the board of the operating company, which is still the main asset of the family. Let's say 80% of the asset of the family is still very much in the operating company. And then the nomination of the outside directors is done through that board, if you want. So our family governance, if you want, is very much all the family office and the family council at the holding company level. That's where all the activities are happening, and then the operating company are. So when we have family meetings, for instance, we typically have half the meeting is related to the operating company, talk about basically presentation by management, et cetera, about the performance, and the other half of the meeting is basically on activities related to the family council and the family office.
And how do you manage the investments outside of the business?
That is done through the family holding company. That's why we have a holding company. So part of the asset of the holding company is basically the holdings in the operating company, and then the other are other assets that we have invested through I think that's all done separately. We don't have a foundation, which is not unusual in Europe, although some families, obviously, as big families, the very large family offices in Europe will have foundations. Our families always have been very philanthropic, but it's been very much at the branch level, not through the family office. I get that question a lot in terms of family home. We had a family foundation at the second and third generation, which was called the Bekaert, Leon Bekaert Foundation. But when we came to all the issues at the third generation and all the things, we basically decided that it would be better to take that foundation, and we merged it actually into the Royal Families Foundation in Belgium. So we now sit on the board of holding the Royal Families Foundation through that, but it's basically run by them and all this. We have nothing to do in terms of the gift or anything like that.
Does the family, are they diversified away from the business, or do they invest in private businesses as well? Or
Yes,
is it,
yes.
Yeah.
Either individually or through the family office. And then in some cases we have, like in some of the branches, we actually had families that we had entrepreneurial venture of some of the younger family members being financed as well. So not through we call it an opportunity fund, but it's not as structured as an opportunity fund. It's really more opportunity to pass the hat for people who want to be. It's not a very structured, it should be more structured. That's one thing that we want to talk. There's a lot of work will need to be done on still, I think, on outside investments, outside of the operating. And I would say today, that probably over 70% of the family wealth is in the operating company, and the rest is outside, either through individual business or through businesses that we invested through the family office.
are those businesses in the same industry?
No, but they're somewhat, and that's another thing about families and diversification, which I think that I'm a firm believer, and I did the same with my family. I think that you have to stay within your core competencies, and particularly when you invest as a group. Individually, it's very different. So you may have an individual family member that may do their own thing in cryptos and to biotech or whatever. When it comes to things that we do through the family, it should be close to our core competencies. When I say close to core competencies, it's not necessarily has to be in the steel wire business, really, but it has to be in manufacturing, something that we understand and know. And I tell our clients this all the time when we think about a diversification of their direct investments, is try to stay as close to your core competencies as possible, and start by defining what your family's core competencies are. And that's not just core competencies, is not just the sector in which they're invested. Core competencies has to do with the philosophy of their investing in, environmental issues, your comfort of leverage, no leverage, all this. And one of the things we have not done with our family yet, which I really want to do, and we've done with many of our clients, is to develop direct investment policy statement. And that includes the core competencies of the family in it. Those are the sector, those are the things that we want to look at from a direct investment perspective. That's one part of the direct investment policy statement. But so to answer your question a different way, if you want, when it comes to investment that we make through the family office, it's very close to our core competencies. Things that are outside where we help family members finance ventures and whatever, it could be very much outside of that. But when it comes to the group, it's basically, and could be a manufacturing business that's could be even at the limit, could be even automotive. Because those are sectors that we touch through our family business, so we have some knowledge of the business. Not that we want to make cars necessarily, but there are parts that we make for cars. The other thing we also want to do when we do direct investments through the family office is to make sure that we can use the information that we have from our family business into those sectors. So benefiting from that instead, and that's pretty typical, I think, for what I've seen with many family companies. That we have a client in Latin America, as an example, that's in the fashion business, and they're looking to diversify outside of that fashion. They do garment, basically, and we help them develop a direct investment policy statement, starting by defining their core competencies. And so when you think about that, it could be, okay, it's not just making clothing or making textile product. What did you learn from that? So you start going around the circle, if you want, from the core of what you're doing to the next circle. You touch upon distribution because you got a huge infrastructure distribution knowledge through your business about what does it do to work through Amazon, what does it do to doing all the different that your So those are all core competencies that you acquired as a business, and for them and then we go further up into areas that are more technology driven and whatever. But the point basing is that you start with your core competencies and then you expand from there to diversify, if you want, into your direct investments.
What do you think families get wrong about direct investing?
I think families underestimate the pain and the difficulty in doing direct investment. Doing a deal, Joe, is very easy, right? Making money out of a deal and getting out of it as a profit and really is a much harder proposition. And that's why I often counsel our clients to, when they think about direct investment, don't think about direct investment in, okay, I just want to invest business. Look at more the illiquid part of your portfolio and diversify that illiquid part of your portfolio in different pockets. And one of them it could be co-invest with private equity funds. First of all, invest in private equity funds, okay? Co-invest with other families. Maybe do co-invest with private equity funds on a co-investment basis and all this. And also direct investments. Because you learn from each one of them in terms of how you're thinking. Particularly if you start a direct investment portfolio, learn from all those different parts. If you want people that have been very active in anything, don't be shy of basically learning from. So I think the first mistake is we see many that they underestimate the work that it takes to really think, and therefore what talent you need to be able to really run a direct investment portfolio. I think the other mistake they make often is they're being way too opportunistic and not strategic enough in their direct investments. And it's very typical that when you're family, particularly when you look at some of those family offices that are not necessarily in New York or metropolitan or Chicago metropolitan areas, but more in the Ohio, all this, they have those significant large family offices that have liquidity to invest in direct investment and become very opportunistic and not strategic. And what I mean by that is basically that they get approached by many people to put money into their, and instead of thinking strategically, how does that fit into the strategy, the wealth strategy of the business, of the family, how do we want to grow the wealth from a transgenerational perspective, they think more about a deal. And we've seen families investing into AI, and because this is what everybody wants to invest now is AI and all this, and there's no strategy behind it. It's just, look, it sounds like a great opportunity. And all of a sudden, it may be great, but they're not venture capitalists. They're not equipped. So I think that's the other, mistake that many families do, is they're not strategic enough. And again, that's why I go back to, when you start getting into direct investment, set up your direct investment policy statement, understand as a family what you want to invest in, how you want to invest, what risk you want to take, and stick to that playbook if you want, in terms of instead of being just opportunistic. And we have a client in the Midwest that lost $300-400 million in opportunistic direct investment that they shouldn't have been made, and it just gone.
What goes wrong in a situation like that? It was a lack of foresight, or
it's opportunistic. It's the fact that they didn't have a way of evaluating those investments properly outside of what the people that they rely on, which was basically the people that were promoting the investment or the management of those investments. And two is, I think that then you make the common mistake of saying, okay, I'll put the first $50 million, but I guess if I put the other $20 million, it's going to be all good. And then you put the other one, but before you know it, you're in for $150 million in investment you have nothing to show for. So I think and that's also obviously lack of discipline, but we see that a lot, Joe. We see that a lot, that they're getting into direct investment and families. And I would say that the third element, I think some families should never get into direct investments. They just don't have the mindset of running businesses. We have a family in Georgia that sold a very successful cosmetic company, several $1 billion, and they come to me and say, we want to do direct investment. I said, you're just not equipped to do that. Enjoy your life. You have more money to do whatever you want to do. Why do you want to do that? And so I think that families, if they get into direct investment outside of the sexy part, if you want, of doing direct investment, it's fun and all this, and we own business and all this, is just think about, why are you doing this? What do you want to do? Is this because you want to create more return? Is it because now, in my book, I think the reason why you make direct investment is because I think it's a lot easier to keep a family together around long-term direct investment than around a liquid portfolio. So if you have a really transgenerational vision of your family about how they want to manage their wealth across generations, I think having a portfolio of direct investments, because what that does, it reestablishes the brand of the family. And the brand of the family is really the brand of your equity is really what makes you successful as a direct investment, ultimately as a family. Families, when you own operating businesses, when you own the legacy business, that defines your family. That's who you are in your community, in your thing. When you lost a family business and the family has been sold, you lost that brand. And you got to reestablish that brand. And if you don't establish that brand, if you don't define yourself who you are as a family, you often run the risk of the money just dissipating or just separating and really not losing that cohesion of the family. As I said, some families are not equipped to do that. At that time, they either have to partner with other families to do that, to do the direct investment side, not doing it themselves. And I would say, to go back to your original question also, I think the other weakness of family offices doing direct investment, the mistakes they make, is that they underestimate the competition for talent. And the problem that family offices often do when they compete with talent, particularly in the private equity fund world, and because that's ultimately where they're competing for. If you're looking for somebody to run your direct investment portfolio, you're typically going to beat somebody that has a similar background as somebody coming out of private equity funds, or certainly you try to hire the same people. And the problem that family offices have is that they don't have the frequency of deals that private equity funds do. So when they do direct investment, because they're long-term investments, they may do one deal a year or may do one deal every other year. They don't do 4 or 5 deals a year. So it's hard to keep people, one, motivated on your staff, and two, compensated when you compete with. So I think the difficulty of attract and keep talent is something that often family offices underestimate when they go into direct investments. I know and I won't use the name, but it's a very famous, very prominent Chicago family that went through, over the last 10 years, went through 3 different teams of direct investment professionals that they couldn't keep them. They got hired away by private equity funds because there's enough deal flow, enough to be able to compensate people properly compared to private equity funds. So the search for talent, I think, is a real challenge for direct investment, for families that want to go into direct investments.
Let's backfill a little bit. You were 10 years at Smith Barney working with family businesses, and then what did you do after that?
So then Smith Barney went through all the duration of the 90s in terms of and so I decided basically that I had the entrepreneurial bug and started my own business. Initially in consulting with Smith Barney. It was purely a consulting business for family offices and family companies, and then basically we turn over the deals, any deals that come out, and we turn that over to Smith Barney to execute. And then that lasted for a couple of years, and then we got the umbilical cord all together and decided to go on my own and then we built a investment banking part of our business, working with family businesses. We had at that time set up a small private equity fund called Family Capital Growth Partners, and that was basically a fund that was funded exclusively by family offices to do investments into family businesses. So it was the initial model, if you want. And then when that fund was fully invested, before we liquidated it, I kind of think, okay, so I'll raise another fund, which would have been the typical route. And honestly, I didn't want to spend a lot of time fundraising, which is a really painful exercise, and thought then for the opportunity to really develop a network of single family office that are interested in making direct investment in family companies and really creating. And I saw that at the intersection, on one hand, family companies looking for more permanent capital sources, long-term partners that are more value compatible, that are, as opposed to just a private equity fund, so looking for longer term. And then on the other hand, so family offices that we were talking to, that were looking to opportunities to invest with family companies and invest on a longer term basis and not be hit by all the fees in private equity funds, and really having a more long-term thing. So between the two, if you want a family office on one hand looking for more compatible investment opportunities and family businesses looking for more compatible capital, we then put together what's called Family Capital Partners. which was a successor, if you want, to our fund, but it was not a fund structure. It was basically just an ad hoc. So we basically did at that time many deals where essentially play marriage between family businesses and family offices as partners, either to fund a legacy business or family business that are looking for liquidity for shareholders or looking for growth capital, or at least partner together on a specific venture to actually buy businesses together. And I'm always a big believer in that whole symbiosis between business and family offices. And as you and I know in our world, I mean, the line between family offices and family business becomes more and more blurry, and it's that private capital is probably where it all comes down to. And then 8 years ago, we founded, a partner of mine, Jim Bly out of Pittsburgh, and myself founded a business called FODIS, which is the Family Office Direct Investment Services, which basically is acting as an outsourcing arm for family offices that want to do direct investments. Recognizing the difficulty that family offices have sometimes to do direct investments, either because they don't have the talent, because they don't have the deal flow, because they don't have the whereabouts to be able to, I think. So we create a firm for this where we help with the strategy around direct investments, the sourcing of direct investments, the execution, and ultimately the follow-up, if you want. That's been going on for 8 years, doing great. Many clients, most of our clients are large family offices that have operating businesses that are looking for an additional direct investment. One of our clients here is a large company in the Northeast that's they're making miniature parts for aerospace and defense. Extremely successful business. And they had, over the years, accumulated close to $800 million or so of excess liquidity in their family office, which was all invested into the market. And as they saw the next generation coming on stream, they decided basically to take that part of that liquidity, if you want, and invest it into direct investments. So we basically are, for one of the assignments that we have with FODIS right now, is to work with that family and their family office and their holding company to identify, and we have 3 opportunities right now that they're working on that would be terrific investments for them. They're somewhat related to the aerospace and defense, but totally different products, if you want, that they're invested in. But we help them develop their core competencies, we help them develop their direct investment policy statement, and then working with their existing wealth manager, who happened to be JP Morgan, on allocating the capital between the liquid part of their portfolio and the direct investment. Because that's also something that often families understand. When you look at direct investment, you need to look at the overall portfolio, if you want, and not just look at a single asset. The anecdotal thing is one of the family businesses that we work with way back when had one of the Coca-Cola bottling franchise, and we looked at direct investment. There were some of the things that they were looking at were same sector direct competition with. So the whole portfolio has to be coordinated, obviously, between what's holding in the liquid part and what's in the direct investment side. So.
How do you think families, on that question, should think about constructing a portfolio? How much should they have in directs? And when they do, how should they manage that risk?
I think the construction of the portfolio, I think, for me, has to be depending on where you start, right? So the first question I would ask is the size of obviously there's a legacy business there, and what the cash flow generation of that business is. So depending on that, we've seen families that have, I think the average today in direct investment, according to the latest study, I think it was UBS or whatever, was between 10 and 15% in direct investment, which is probably what they should own. I think a lot depends on what their long-term strategy is as a family. And because the direct investment side, it's not just, for me, just an investment product. It's also a way of perpetuating the wealth for the next generation. It's an opportunity for the next generation to get involved in businesses. It's got a lot of other factors, if you want to involve into the reason why you're doing the direct investment. Therefore, it's hard sometimes to just put into, say, you should have X percentage into direct, X percent into private equity fund. I would say that the families that I've seen very successfully had probably an equal part in their illiquid of direct investment and private equity fund investments, or co-investment with other private equity funds. And that, for me, that makes a lot of sense, because I think that you're in the traffic, you learn, so I would size that, if you want, in terms of, and then depending on how liquid or illiquid the family wants to be, obviously depends on family members, the cash flow, what the holdings, and my family, we're a very illiquid family. We're illiquid in the sense of many of our assets obviously are directly invested. Now that's as a family. Now individual groups may have a different allocation if you want in terms of, and that's something that you see in many families actually, is that you start having, as the wealth develop across the generation, you start developing pockets of wealth at subgroups of the family, if you want, that have developed basically because either investment they made on their own or just a very generous dividend policy that the family has been over time and have been accumulating. So we see for each of the, and I'm thinking about one family in particular that we're working on right now, where there's about, if you look at the family office wealth itself, it's less than 50% of the total wealth of the family, because the rest is with the individual family members as part of either their own family office or obviously the larger families that we know, the Waltons and all this, they're the same thing. We obviously have all accumulated significant wealth outside of their holdings in Walmart and outside, so all have their own family offices. And then the question is, which is interesting, with this particular family you're talking to, is okay, how do you then coordinate the policy, if you want, the investment policy of the core assets of the business, of the family, that are the common pool, if you want, versus the other individual pools that they have. When you ask the question about how much to think, it really depends on how the wealth is spread out. But if you took an overall pool, I like to see a model where you have equal portion, I think, in direct investment and in the private equity funds.
So it might help to walk through a particular deal. Is there any that stand out?
One of which is a deal that we actually did a couple of years ago. Family business, they had a small family office, and they sold a significant part of their business. They're one of the largest companies in the country that make fertilizers for they also had a sulfur business that was making essentially the sulfur that being, the processing of sulfur basically. So it's very chemical, industrial, I think. They also made animal feed. They started as a trader, actually, commodity trader in New York back in the 19th century. And at that time, New York was a big center of commodity trading of different products and all this. And then they eventually then developed into animal feed business that they actually started making in the Midwest, and a very successful business. And then as part of that, they had developed a fertilizer business, which they ultimately sold, and that's what the beginning of their family office. And that was a $400 million deal that they, at that time, that was about 10 years ago when they sold that business. And we started working with them 5 years ago, ended up closing a deal 2 years ago, large deal, where they ended up essentially buying the sulfur business of Bill Koch in Palm Beach. And it was called SBO, and the business was a very successful business, very complementary to what they're doing. And they now became essentially between Koch business and the sulfur business that they own themselves. They're North America, they're the largest supplier of sulfur for fertilizers and whatever else is used in the. And it was a great deal because I think it was a good dynamic and partnership setting up the direct investment between Bill Koch's family office and their family office, and they ultimately became partners initially. So Koch maintained a 20% interest in the business. Our client bought 80% of it, and then over time, essentially, the Bill's family office will eventually sell that 20% remaining interest. But very interesting dynamics from a family perspective, because the leader of that family office that really pushed for that direct investment had to manage his board, and the family board particularly, because the family was very comfortable owning that liquid asset that they had from selling so the whole dynamics there was really around how you convince the merit for the family office to actually make that risk, to actually get into a direct investment as big as that if you want for them. And is it worth the risk? And also it paid off because it's been a tremendous investment for them. If it was not for the partnership that they were able to develop with Bill Koch and his family office at the outset, and how the deal was structured with the 20% remaining interest by Koch and 80% by our client, and how they, over time, transition management between their team, our team, et cetera, was so. If it wasn't working with the family office that was long-term oriented, as the Koch was as well, and willing to support the growth of the business with the new owner, I think that deal would never happen. Like it It was a very interesting, beautiful deal. It paid off for everybody. By the time we identified the business, and by the time it took the better part of a year, actually, to get the whole deal put together and closed. The other ones, too, I think there's a business which is a manufacturing business in the Midwest that we did a deal with where the principal shareholders, who was second generation, very involved in the business, very autocratic leader, if you want, and not really interested in doing direct investment. They had a significant family office. They had an operating company, the manufacturing company, the family office that had liquid assets of $400 or $500 million or so, significant size assets to do direct investments. And the whole history of the business, the family has always been investing in that particular chemical business that they had, manufacturing of chemicals. And it's really the next generation that came to really their granduncle or grandfather in some cases and pushed for direct investment. They're actually the one that called us and said, can you help us work with that older generation to convince them that we should do direct investment? And so anyway, we end up doing not a very big deal. It was a $120 million deal for them, but it's an investment now, which is interesting. It's actually all run by the next generation. So it's set up their own governance, and the capital came out of the pool, of the family office pool, but it's really run by the next generation. And we see it a lot. We see that more and more now, that the push for direct investment often comes from the next generation. They want to get more involved in either they want to get into their own business or they want to do into direct investments.
So private equity is a big industry. It's very efficient. Do families have any competitive advantage in these deals?
They do. I think they do, because I think that the fact that they can actually look at a deal on a very long-term basis, I think on a price-wise, I think they're very competitive. We're looking at a deal right now for a client, and it's a $100 million direct investment. And it's not a family business. It's actually a subsidiary of a Fortune 100 company. And it's not for sale, technically. If this owner, public company, Fortune 100 company, can get a very significant price for it, they would consider selling to our client, which has happened to be a family business or family office. I think that if you take that deal and you would show it to any private equity fund, they would say there's no way we're going to pay that kind of price. I think that family offices, and we're talking about a multiple that was probably 3 or 4 turns EBITDA above market, because they say, look, we don't have to sell the business, but we can get a good price for it. We think it's a phenomenal business. We think it's in a business that has a lot of synergies with our client in terms of core competencies, in terms of their legacy business, in terms of what they're doing. And when we put all the numbers together, we actually can justify paying the price that we're paying for the business. I think that family offices have an advantage when it comes to, and that's another part that we see now more and more, all family businesses that have been bought by private equity funds are looking for family offices as an exit for coming out of the private equity fund model, because they look at family to be, I wouldn't say more friendly, but more long-term oriented, or more compatible with the goal of management, if you want. But I think family offices for sure can be very competitive in deal flow. The question I actually have is they don't have competing with private equity funds, Joe, is they often don't have the deal flow that private equity funds. They don't have the infrastructure to develop the deal flow. When it comes to a deal, they can be extremely competitive. And that's not just price, it's also that they're a very attractive buyer for management. Where we've been most successful in direct investment with private equity, we talk to a family business, that every family business have been approached by private equity funds multiple times. When you tell them we're not a private equity fund, we're actually a family investment company, or we're a family office, the whole dialogue totally changed. And so we had, in many of our work that we're doing, we'll be approaching potential family business targets as an investment for our clients. The doors open as soon as we mention it's a family group. Just because the dialogue for the families would be very different. Many family businesses have heard the horror stories about being owned by a private equity fund and that they're doing this and that and all that. Some of them is justified, some of them is not, but the point is they hear. So then they're not too, but when you tell them that, hey, this is a family that's thinking long term, that is looking for, and not necessarily looking at managing day to day, but really help develop the business. I think it's I think they can be competitive on the deal sourcing side, and I think that on the return perspective, you're looking at, as I said before, a long-term return. You can justify prices that don't amortize over a very long period of time.
François de Visscher, thank you for joining us and sharing your insights.
Thank you, Joe. Appreciate it. Thanks for having me.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.